Hey guys, so today I'm going to answer some questions that I received in the past couple weeks from either Twitter or my website comment section. They are really, some miscellaneous questions that don't have a general theme about it, but some of the questions is about the recent market movement. As you know, something the past week has been interesting, um, about Ukraine, right? And then that caused some market donations in all the risk assets. And crypto somewhat recovered after that, but it's still, we're in a volatile market. So I'm going to talk a little bit about that and also some other questions. Um, so let's get started. First question from Dave S. Please explain why it's easy for markets to price in rate hikes, but difficult to price in quantitative tightening. So I don't remember what this comment is responding to because I'm just reading off a list of screenshots that my assistant sent me in a Word document. Essentially, it doesn't have a context, but uh, I guess at some point I mentioned on Twitter or on my website that it's easier for the market to price in tightening. So because some people are saying, the Fed tightening effect is already being priced in by the market, right? I think that's only half true. If you think about it, because it's easier to price in the rate hikes, it's not so easy to price in the quantitative tightening, which is Federal Reserve selling off the U.S. Treasury is holding, or the commercial, corporate bonds is holding, in other words, reduce its balance sheet, right? So why that's more difficult to price in? There are a few reasons, but on the most simplest level, if you think about it, with a rate hike, you have a definitive number of how much the Federal Reserve is going to hike its federal fund rate, which is essentially a short-term overnight rate that banks in the United States use to borrow money overnight to each other. Okay, so it's like a rate on interbank short-term liquidity, but of course, once that rate changes, it has the spillover effect to other short-term rates, right? Because if that cost of short-term funding increases for banks, then banks gotta start. It's just like any businesses. If your cost increases, you're gonna start charging your customers more, or figure out more ways to get more money, to make more money, right, to cover your cost. So it's the same thing. So federal fund rate, it's a short-term interbank rate, but when that increases, it gets spilled over into the rest of the short-term market, borrow lending market. And from the short-term borrow lending market, it can, spill over the so-called monetary transmission, right? Spill over into more longer-term borrow lending products. So that's how it goes in terms of traditional monetary tightening. But that effect is, it's sort of easier to calculate because, like for example, in March, let's say the Fed increases the federal fund rate by 25 basis points. So that's 25, right? So you can you can easily just adapt your assumption in terms of, okay, how much the short-term interest rate is going to move when the federal fund rate moved to 25 basis points. You have a lot of historical data you can reference, right, from historical experiences. And in the worst case scenario, you just assume 25, right? 25 basis point interest rate changes. And that feeds into all kinds of asset pricing models that people use to price, like discounted cash flow, for example. You assume some kind of interest rate, right? So now interest rate changed, and you know by how much, and you plugged into your model, and you get a new asset valuation. And that will be the new price that you target, right? So if the rate increase, that means if your discount rate increases, that means your discounted, if you're in the discounted cash flow model, for example, that means your present value of your future cash flow like a reduce in value, right? So that means the current day's stock price should be going down. By how much? depends on how much you assume that interest rate increases, which you basically more or less know from how much the interest rate hike is, right? The same thing with bond market, right? You look at how much you assume that interest rate change, and you can price use to feed into your pricing model for the for the price for the bond. So so in that sense, it's the number is definitive, and also you have a long history of historical values that you can reference to see how much historically, Fed raises 25 or 50, how much impact that has caused in the credit, in other rates in the market, right? But with with quantitative easing or quantitative tightening, which is the opposite, it's harder because it's both. It's both harder in a quantitative sense because you don't have a definitive number, right? Even if okay, Federal Reserve next month is going to reduce its balance sheet by 10%, which is a huge number, by the way. It's not going to happen in a single month. But let's say it's reducing by 10%. So that it's selling for X amount of Treasury securities, for example. But still, it's still quite hard to grasp how much of a price impact that will have on the market unless you know exactly what that supply demand curve of the Treasury market is, which is very hard to estimate, right? At least it's harder to estimate. You don't know what exactly that selling is going to have. The impact is going to have on bond prices. It's going to be going down because the Fed selling, of course, bond price going down, but you don't know by how. It's harder to know by how much, right? And also keep in mind, we've had the biggest QE ever, all right, unprecedented since COVID started. So it's really an order of magnitude bigger than the other QEs that the Fed has done in the past. So you don't really have a linear historical reference for this. Okay, so to what extent this going to hurt the asset market once the Fed starts to sell off its balance sheet assets? Nobody freaking knows for sure. That's why I said. If you think those impacts are priced in, I don't think so. Okay, I don't think anybody has a definitive answer about what the exact impact a QT would be, even if you know how much the balance sheet is going to reduce. And not to mention that right now we don't know. Okay, so that's that. Next question from Flores D. What's your plan going forward from here? You said in your newsletter that we could get some kind of market recovery short term, but overall bearish long term. Well, I'm not really bearish long term. Well, it depends on how you define long term. Okay, my long term is like 20, 30 years. But maybe Flores is meaning like long term as in the next year or next 2 years. So he says, you're gonna sit and wait and buy after it all goes down, or invest as soon as the market shows recovery? So I think this is a comment referring to something that I said on Twitter, because somebody asked about why I haven't posted any of the what I sometimes post, like what I call notes of the day, basically some random thoughts about like trading and portfolio management in my crypto portfolio. So I haven't been posting much because I haven't been doing much, and right now I'm 70% in cash. And that has been actually, I was in full position in end of January, and since then I've been gradually reducing and going more into cash because again, I talked about this several times already, I expect a lot of volatilities in the short term in this market, which has, you've seen, if you look at the VIX, which is the S&P 500 volatility index, it's been going up since like late December or something. So you also see a lot of volatility in the crypto market because a lot of it is, I think, surrounding the macro action from the central banks, right? So so in this kind of market, and also, I right now, frankly, I'm seeing more downside in both Bitcoin and the crypto market in general. It's not, I'm not always expecting this. Like for example, at the end of January, my alts portfolio, the so-called altcoins, were doing pretty well. And then February started, we had a huge downturn, or several rounds of downturn, right? But I always expected that this is a high volatility phase, though you can argue, okay, Bitcoin and crypto prices have been going down a whole lot since November, December, right? So some people say we are already in a bear market. And well, it depends on how you define a bear market, right? What's your time frame? And to me, this is not a bear market yet. We're just in a lot of volatility. So in this kind of environment, and I did expect, like for example, we get a bunch of sell-offs in, earlier this month in February. At that time, I expected we would have a rebound, like a pretty soon. I'm still expecting that. I'll come to that in a bit, okay? So why did I expect a rebound? Because if you look at, how much in the equity market, for example, S&P has been, down by, 20% from the previous highs in November, December, to the lowest point that we had in February. That was over 20%, I think. And crypto market, obviously, it's even more. So, but if you think about it, is it justified? I don't think so, because the Fed hasn't raised rate. We haven't even had QT hasn't even remotely started. We still have Fed balance sheet expansion, right? But it's massively decelerating. I'm telling you, right now it's probably the year-on-year growth is about 10%. I like to look at year-on-year growth because it get rid of seasonalities, and also it gives you a longer time span to allow you to have some kind of perspective. The short-term, month-to-month data is just too noisy. So that's why I like to use year-on-year. But if you look at year-on-year data, the balance sheet expansion has been decelerating since, I think, middle of last year, if I remember. I forget exactly which month, but but I'm pretty sure it was started decelerating since the middle of last year. But it's still growing, right? It's just decelerating. So that means QT hasn't started, rate hike hasn't started. No, you've heard it, certainly you've heard plenty about it. So, but market rates like yields have been going up. We have inflation coming, and we have expectations of the Fed raising coming, right? But at the end of the day, I just don't think that market condition has justified this much of drop in risk asset prices in such a short time frame. Okay, so that's why I expected, in early part of February, I expected that we're going to see a rebound. But then I kept waiting, and I felt, okay, it's going to happen short term, but it didn't happen. So then I thought about it, and I think to me it warranted a change in strategy, because if it's going to have, if I expected to have another leg down in the short term, that means there will be more buying opportunities in the future, though I can't tell you exactly when that will be, right? But I still expect we will see a rebound, and possibly a rebound from now to summer when we have quantitative tightening actually starts. So that's why I have gradually moved into cash over this past month. So right now I'm basically on a lot of cash position, but I fully expect to go back into the market when I think it's a good entry position, when I think we are seeing a rebound forward. Actually, I have gone back into the market just this week, after Ukraine, after the Russian invasion happened, we had the huge leg down in the market, right? And then we rebounded. And then I thought, okay, maybe this is the one. This is the one, and we're going to have the rebound that I was expecting. Okay. So I did enter the market on some of the which ones that if you watch my previous videos, you already know which positions I had, so that those haven't changed. Okay, so I re-entered, but at that point I expected this thing will be volatile, right? So in this situation, I had a tight stop set, and I got stopped it out essentially because the expected more upward momentum didn't happen. Okay, so then so I did try it actually multiple times to re-enter, but I always got stopped out so far because that whatever upward momentum we had, it didn't materialize. So that's the situation now. Is I'm still looking to re-enter the market at some point, because I do expect a rebound at some point. Though there's one thing I haven't intellectually haven't totally reconciled, is that if we are expecting it's not just I'm not the only person expecting a rebound. Okay, I think a lot of people think that we should see that because the downturn of that in that short time frame, that magnitude of price adjustment down wasn't warranted by actual market condition. There is a lot of liquidity sitting on the sideline right now. Okay, maybe they're like me, they're looking for the right opportunity to enter, right? But the thing is, if all of us are expecting that to happen, and then we also expect later this year we will have QT, which means that will hurt risk assets. That means whatever rebound we have is going to be sold into. People are going to be, selling when there is a price when there is a price recovery. Not to mention, people who are not sitting on cash, okay, especially retail, a lot of new people in crypto, maybe they don't have a lot of faith in the industry. They're just coming into the market and because it's a lot of hype, and people think it's a quick way to make money. So those folks may not have a whole lot of staying power or holding power, right? So they may not want to stick around. So if they bought a token, then the price went down, like in the past few months, the price action hasn't been so good, right? So and if there is a rebound opportunity, probably a lot of retail will sell. So that's the part I haven't worked out in, I haven't reconciled, to be honest. So but still, I don't see, because the market condition, financial conditions have not significantly tightened. It's not like mechanically we are short of liquidity in this market. It's just, people are turning more risk averse, so people don't want to bet heavily right now. Okay, so that's why I think some market recovery is in the cards. So that being said, like I have already said a bunch of times, this is a high volatility period, right? So I think if you're like me, by the way, none of this is financial advice, obviously. I'm just telling you um, my opinion about the market and what I'm doing with my portfolio, okay? It doesn't mean that you should do the same. You should do what you think is right. And I am definitely not right all the time, okay? I make a lot of mistakes. Um, so, but I think if you're not a hodling type, this is the market you should at least watch pretty closely, right? Because we are in a high volatility situation. So whatever, entry or exit, you probably want to set a, tight stops and watch the price action pretty closely. Um, but if you're the hodling type, then you do nothing, right? You just stick with your high conviction bets. So by the way, I said I'm 70% in cash, and a bunch of people give me a hard time on Twitter as if I'm fudding the market. I'm sorry, this is I'm long-term bearish. I'm long-term bullish on crypto in general, but my long-term is pretty long. Okay, in the short term, I'm not going to just sit there and try to get killed. So I do whatever I consider is appropriate for my situation and my reading of the market. I'm not saying you should do the same. Okay. So, okay. So, and also with the Ukraine situation, this is obviously another complication for that adds to the market volatility, right? So with the Ukraine situation, some people ask me how what do I think the impact would be? So, to be honest, I haven't thought this in a very profound. I haven't thought about it in a very profound level, but at a pretty surface level, okay, at a pretty superficial level, obviously, first thing, it's gonna likely affect oil prices and commodity prices, agricultural commodity prices, and also some metal commodity prices, because Russia is a big exporter in oil and in grains like wheat or corn and those kind of things. So but oil is the most important, right? So that's going to affect oil prices. If oil prices goes higher, that's bad for the economy and bad for the economy, bad for economic growth, bad for inflation. Inflation will be going up, adding to on top of the inflation that we already have. So that would be a pretty tough situation for the central banks to be in, because you essentially trending towards the stagflation situation, which is high inflation, low growth, right? So so that would be a pretty tough spot. So right now, I think that at a superficial reading is that the oil price impact may not be as huge, or at least if there is an impact, there will be temporary. Why? Because first, U.S. has emergency oil reserves that it can deploy, it can release, and this is definitely you have a continental war situation. It's definitely one of the situations that warrants the release of your strategic oil reserves. Okay. So that would mitigate the impact. And the second thing is there is potentially agreement with Iran to alleviate the sanctions and increase the export from Iran, the oil export. Okay, so those are the mitigating factors, but I'm not an oil expert. Okay, I think this it's still hard to judge right now. So that will be the impact on the economy, and definitely that will affect market confidence. And also the impact will come from obviously right now, I think you probably read in the news or heard on from your friends or from Twitter or somewhere that the Western banking system is pretty much cutting Russia off, right? So that's gonna create some knock-on effect because Russia is not exactly it's not a huge economy. It's not huge compared to how big it is in terms of geography, right? But it's still like about like 1.3% of the world GDP, okay, which is not it's not completely, you can't completely ignore it, right? So when this leg is being cut off from the global, like, international monetary system, you are going to have on the other end the counterparties, investors who have invested in Russia, financial institutions that have lent money to Russian entities. They are going to have trouble with their investments, with their account receivables, right? So if Russia does not have access to international banking system, that means those entities, those peoples, those organizations in the West, they cannot collect their payments from Russia either. So when they cannot collect those, what's going to happen? They have losses on their books, right? If they are in some kind of liquidity shortage situation, that means they will need to sell other assets. Okay, that's how a spillover is created into other parts of risk assets or all financial asset markets. So I think that can be another layer of impact. How big that is, I don't know yet. I need to look into how much account receivables from Russia are. But I expect that's pretty hard to estimate. So that's the second level of impact. And the third level of impact, God forbid, you don't want us to go there, which is nuclear. So if we have some kind of even the mention of kind of a nuclear war involving nuclear weapons, there are people who supposed to be armchair military experts would tell you, this is not likely to happen. I don't know. I think even a whiff of that is enough to scare financial markets, right? So I think in the short term, these are just factors that are gonna increase your volatilities in the market. But still, it doesn't negate the factors that we just talked about. You have like a lot of liquidity sitting on the sidelines, and you have a market that I think has been oversold, at least in the short term. Okay. I think in the short term it's being oversold, so I expect a rebound. But still, I've been expecting it. It hasn't happened so far, but I think it should happen some point from now to summer if we still have QT starts in summer. Okay, so depends on how this Ukraine situation goes. It may affect the response function, may affect the actions from Federal Reserve. So I don't know. It's all things are very very in flux right now. So that's why I'm sitting on a lot of cash, and I'm just waiting to deploy. But the thing is, I'm not really that good about timing market. That's the same. So just wish me luck. That's all. Thank you. Okay, so that's that. But on the other hand, from the fundamental side of crypto, I think actually I think a bear market will be good for the industry for the long term, because the price action has been so fast in the past couple of years, especially in 2021. Okay. It's really at the rate of investing the money in crypto, both from the liquid investment in token or the venture capital investment that is less liquid, from both. Okay, it's a lot of money flowing to crypto. I think it's really growing at a much faster rate than the actual rate of innovation that's happening. Don't get me wrong, there are a lot of building, a lot of creativity happening in the space, right? But the thing is, even with that, even if this is the technology that has had fastest rate of adoption on Earth ever, still, it has a limit, right? Things happening in the physical world, it has a limit of how fast it can grow, and the technologies, it has its own pace of innovation has its own cycles of maturing, right? So sometimes it's just not there. You throw more money at it in the short term, it's not going to give you that result, which means if in the short term you have the growth of investment far outpacing the actual speed of innovation and adoption of real use cases, what will happen is naturally you get a lot of investments wasted on pointless projects, on projects that are not good quality, on blatant money grabs, on you know what I mean, right? So, and we've been seeing, I think there has been a lot of those, especially in the NFT space. So, so you see, I think if this goes on for extended period of time, this kind of thing goes on for extended period of time, it increases the fragility of the market, because makes the valuation of your project more and more fragile. Okay, so it increases the probability of a violent crash instead of the mild downturn. Okay, so I just don't want us to get a violent crash, because I just don't think that's good for crypto at all. Because you want people to recognize this as a gradually maturing asset classes, not a asset class that is perpetually volatile. Okay, that's always full of drama, right? At some point you want to graduate from that and grow into adulthood, right? So and if you want mainstream adoption, that we've got to have more stability, we've got to have more sanity in this market, and we've got to allow room for projects to actually have the breathing room to actually catch up to the rate of growth in the money flowing into the market. So that's why I think it's extended bear market, a relatively longer bear market, not a bear market that is just a couple months, right? I think it would actually be good for the industry going forward. So otherwise we will have violent crashes, which is not optimal for the long-term health of the industry. But obviously nobody wants to hear that, and when I say that, people think I'm fudding. So, but so be it, right? So, but actually we've already seen a lot of it, which is something a chart I just posted today on Twitter, which somehow people found it controversial. I don't know why. And I posted this chart about the growth rate of stablecoin market capitalization. Basically, the two biggest US dollar backed stablecoins, or supposedly US dollar backed stablecoins, which is the Tether and USDC, right? So if you look at the growth rate of these biggest ones, which is essentially maybe like 90% of the total stablecoin market cap. So this is actually, I think it's a good measure to tell you how much new money is coming into crypto. Because this is, obviously this is it's not a precise measure, because people, go in and out of stablecoin for all sorts of purposes, right? But if you think about it, in order for these stablecoins to increase market cap, okay, you need to have actual US dollar going in to, to, for example, USDC is the parent company is Circle, right? If I want if for new USDC tokens to be created, some investors need to go in with actual US dollar. I say, the Circle, here is my $5 actual US dollar cash, give me $5 USDC token, right? So that's how USDC is created, roughly. The same thing with Tether, right? So you can use the market cap of these two as a rough gauge, as a rough measure of the rate of new money inflow, actual dollar inflow into the crypto market, right? Since I don't have a really comprehensive measure for this. So if you look at the growth rate of these two stablecoins adding together, the growth rate has peaked in April 2021, and since then it's been going down. Okay, but the growth rate is positive. So I posted this, and people try to argue with me. What are you saying? Look at crypto, like a stablecoin market cap is still going up. Yes, I know, but I'm talking about growth rate. Okay. If you remember your high school calculus or whatever, the growth rate is the rate of change in your underlying level, right? Of course, the level of the stablecoin market cap is going up as long as growth rate is positive. Okay, the level is going up, but the growth rate itself is declining. So, like, say, about 5 months ago, the growth rate is 20%. Right now, it's let's say it's 10%. Then that means the degree of change is decelerating. Okay, so yes, the market is still growing. The stablecoin, market cap is still growing, but at a decelerating rate. That's what I'm saying. So, I hope this is clear. So what actually, I should have looked at this. I should have thought of this earlier. This is actually, I didn't this didn't come to mind until recently, right? So to look at the actual rate of growth in stablecoins. So if you look at this, you see that stablecoin market cap has been growth has been decelerating since April last year, which is sort of when I think the momentum in crypto greatly reduced. That was when you see, like in May, we saw a pretty deep retrace, right? And then it went back up, then it went back to the high of November, but it was on a much weaker momentum compared to first half of 2021, right? So I think what this tells you is the new money inflow is we still have a lot of new money inflow, yes, but not at least not at a accelerating rate, right? And to me, it seems reasonable to say that for a market that, like crypto market, that is pretty much denominated in US dollar, right? And stablecoin is 1-to-1 exchange rate with US dollar, right? So for a market that's denominated in US dollar, if you want the market cap of this market to go up a whole lot against the US dollar, right, there has to be more and more US dollar coming in, right? It's not even enough. It's not enough for the growth rate to stay constant. If there's always like 5% growth, if the growth rate is 5% of new US dollar coming into the market, that's not gonna create that's not gonna make prices go up, right? Because you need to have you given a set amount of token, right? You need to have in order to create a increasing price denominated in US dollar, you need to have accelerating amount of US dollar coming in. It cannot be just like a constant rate or a decelerating rate. Okay, that's not gonna give you new time high in a market that is denominated in US dollar. So that's why I said I wish I thought about this earlier. So if you look at the year-on-year growth, of the dollar stable coins, you see that the growth rate has decelerated since middle of last year, which coincides with the deceleration of market cap growth denominated in USD in crypto market. Okay, so what does this mean going forward? So if we get a rebound, I think it's likely that we get a pretty sizable rebound, market recovery. But I do think after if we have QT, I think the rate hike is not as much to be feared as QT. That one is more of a wild card, partly because the reason we talked at the beginning, that impact it's harder to price in. It's more unpredictable because this is really unprecedented quantitative easing that we've had in the past couple of years. So once we have QT started, I think we may see a real bear market starting in crypto. So that would be my baseline. So what would I be doing then? And if you watched I think one of my previous videos, when I said, when I talk about what to do in the bear market, right? So to me, I'm long-term bullish about this market still, even though in the short term I see a lot of shit. So I think so that's what I think I would do is I will hang around, but I will try to put more assets into. I will obviously consolidate into assets that I have a longer term conviction on, and preferably assets that are cash generating, which means through some kind of staking, mining, node running activities that can generate a cash flow. To me, that kind of project it's almost like the from growth to value rotation that you see in stocks. When the market is down, you generally have this so risk tolerance is lower, then you have this shift from growth to value, right? What is value stock? And the value stocks are those that may not grow like a spectacularly overnight, but those have like a relatively stable cash flows, right? Essentially, those are cash cows. So those become more popular in a more risk averse market, or in a higher interest rate environment, right? So I think this type of thing, of course, there's no value. There always growth. There's no value. It's just ridiculous to talk about value in crypto because everything is growth, right? Everything is risk on. But still, relatively speaking, I think those that gives you a cash flow is the counterpart of value in traditional investing, if you will. So, because I don't really have a better analogy for this. So I think those will be more popular, which is the kind of tokens that you can actually stake and earn a yield from a underlying economic activities. Okay, so so where does that yield come from? For example, I talk a lot about these layer one stakings. The yield comes from token emission and comes from the transaction fees, right? From Ethereum to Solana to Avalanche, Phantom, it's all quite similar, right? Just the difference is in a matter of degrees. So these are staking, and these are products that offer staking yields. And also there are another kind is if you help the decentralized network to fulfill its function. For example, the ones I participate in are the Gala games, Helium, Pocket Network. Those are the ones that I'm in, and I may get into more of those when we have if we have a proper bear market. So basically, my plan is to look for a good entry so that I can scoot the tokens that I want back and earn yields in the bear market. So that's the current thinking. Okay. So so you can look into those. But I can tell you, but still, even if you get a cash flow from those projects that has yields, keep in mind in the bear market, your yields are worth less, right? Because your yields are in tokens, and tokens will be worth less in the bear market. So you may try to set a realistic expectation of what the actual yields will be. So so from that lens, again, it's not investment advice. If you look at you can look into, for example, how much it costs to invest it in hotspot of helium, how much it costs to invest in a node for Gala. Last time I checked, it's like 80K in US dollar, more than 80K. I don't remember exactly, but it's not exactly cheap because it's like on a sliding scale up. Because more people buying those nodes and the price goes up. So you gotta do the calculation and see if that investment still makes sense to you. Okay, I can tell you I got in much earlier, so this does not apply to me anymore. So you gotta look at it and see if that makes sense to you. Same thing with Pocket Network, and some people ask me about running nodes for Pocket Network. You've gotta do your own calculation, okay? Because essentially, I think I talked about this last time. The node is basically a decentralized Infura, right? You help run those nodes. You help deliver those relay calls. And then you earn some token. But right now the project is not really making money. Okay, it's a nice concept. The project's not really making money, so the tokens you get is just like the staking yields that you get from the layer 1 chain tokens. It's primarily from token emission. Okay, so it's in other words, it's from money printing. Okay. So you gotta think about that. You gotta think about how much whether that is sustainable or not. I think if the project gets traction, if their user base continue growing, then maybe it's a good opportunity. But the token emission right now is pretty high. And I can tell you the number of nodes, if you look at the Pocket Network statistics, how would you check those? Just go Google Pocket Network stats. Let me see. Pocket Network network statistics. Yes. Just do that and you will find it. So Google that. So I think you will see that the number of nodes the number of network nodes joining in the network has been going up at a much faster rate than the actual business demand of the network. So again, this is another manifestation of the issue that I just talked about, right? You have investment money coming into the space at a much faster rate than the actual adoption or use cases and the actual building that's going on in the space. So you do your own research and make your own judgment on this. But these are like potential risks that you should consider. So in other words, let me try to summarize this. I think the bear market the relative value. We will have like a rotation to a relative value in crypto, if there is a thing called value in crypto, which is the projects that can give a sustainable yield through underlying economic activities. Okay, at least partly through underlying economic activities. But how much those projects are sustainable, you got to judge on a project by project basis, and also you have to look at your rate of return and how much you're required to invest right now. Okay, so that's that. Gosh, time flies. We're already running out of time. Next question from Susie Y. How does a project token coin value relate to value of underlying tech or company? Is it like a share or just a token value dictated by the market, vaguely associated with use case, but mostly hype? Or is it intrinsic value? I don't remember where this comment is referring to, but I understand what she means. What he means. It's basically, in crypto, it's not like stocks, which are presumably your ownership. You buy a share of the company, meaning you're an owner, okay, of the company, in a certain percentage amount. In crypto, you're not exactly. It's not exactly an ownership contract, right? And in some tokens, you get a share of the revenue of the protocol that is being programmed in a smart contract. But in some cases, it's just a token. It's like a governance token, and the people make fun of this all the time, right? It's useless because you get what? Nothing, right? So then people have problem with that. So I actually wrote an article about this. It's called "Is Asset Price Valuation a Meme?" And I recommend you check it out because I think it's a fun topic. So what does the price of useless governance token mean? Right? If you're not getting the underlying cash flow of the project, and you're not presumably a owner of the project, right? So what exactly it is debatable. But here's my view. I think you can also say the same about a lot of stocks, unless it's a traditional stock, Berkshire Hathaway, or something, Coca-Cola. That is a stable going concern. It's a strong business. It generates a cash flow. It delivers dividends to shareholders on a regular basis. It's predictable. Otherwise, if it's a growth stock, it's a growth company, you're not getting a dividend, right? You're not getting much of a shareholder say exactly because you are presumably a small shareholder. So what does it mean exactly that you are a share owner? You're a company owner. To me, that's in name only. In substance, that is entirely lacking. Some people say, okay, even if you don't get a profit share through dividends, companies will buy back stocks when they have profit, so you indirectly gain, right? But you can say the same thing. That's just companies arbitrage, right? So but you can say the same thing about useless governance tokens, right? If the company, if the project thinks it's profitable to buy back its tokens, you can do that, right? So you can also benefit in that way. So to me, the distinction between stock ownership and token ownership is a thin one. I think the boundary is extremely fluid. Okay, but in terms of this intrinsic value thing, okay, I think even if you don't get a dividend, something can still have a positive price. But it's just from another mechanism. You're playing another kind of game. you're not getting the value from the company itself. You're getting the value from other participants who bet in the other direction than you about where this company is going. It's the same thing like, you go to a horse race and you gamble on horses. You bet on horses, okay? There are 5 horses that you bet, okay, horse A will win, all right? And if all the other participants bet on non-horse A and horse A won in the end, they all pay you money, right? So I think it's sort of a similar game that you're playing. It's in the crypto market or in the hyper financialization market, where the shareholder, what it means to be a shareholder is increasingly tenuous. Okay, so this market is these markets are essentially a horse betting market. It's the same rule. You bet on the horses. There are a bunch of liquidity in this market. It's like people buy the tickets to bet on different horses. Okay, so you have a bunch of liquidity, and then some horses run faster than the other. If you are good at betting some faster horses, and the value of those horses, the price tag of those horses will go up, right? Well, the difference here is horse betting is like a 1 round game, right? So you bet first, and then the horse runs, and then it's done. Then you clear out like who owns who. That's a 1 round game, betting game. In the crypto market and the stock market, it's a multiple rounds, it's a continuous rounds, right? Because the fundamentals of the company, of the projects keep changing, and you have to adjust your expectations and so on and so forth. And liquidity situation of the market changes, affects all the horses altogether. So, but I think the similar rationale applies. You are basically betting against all the other participants in the market to find that best horse. And the implicit rule of the market is to say, even if there's no like horse betting board, horse betting committee committed into writing, but the implicit game of the market is that the horses, the projects that run faster, their prices should go up. Their value should increase. Value in terms of how much their token is worth. Okay? Even if you does not get direct cash flow or dividend from the project itself. So do you call this intrinsic value, or is it not an intrinsic value? I mean, what's the intrinsic value of a horse betting ticket in a horse betting game? So I think this concept of intrinsic value, maybe it's just not a very helpful concept in the modern financial market anymore. So but that's again, I'm not saying I'm right, but hopefully this is something for you to think about. Okay, so I think that's all for today. And some people, I see some comments on YouTube asking me to post timestamps. Guys, I'm sorry, but this is not my job. Okay, I do this for fun. The kind of timestamp, this kind of thing that gets into the nitty-gritty logistics. I'm not a logistics person, okay? I don't like doing that kind of thing. I don't even like telling other people or hiring other people to do this kind of thing, because it's just more chores, okay? Once it becomes like a work, I don't feel like doing it anymore. So I hope I want to keep this as a fun thing to do. That's how I will have motivation to do this. Once it becomes work, I'm sorry, I would just start dragging my feet about posting these. So if you want to have like time, if you want to, if your problem is you can't listen in one sitting. This is a podcast, okay? You can find this on your podcasting app. You can find it in iTunes or Spotify, on Google Podcasts. Just search for Tasha Labs, okay? And just listen as a podcast, not on YouTube. And then you can listen anywhere you go. You can listen offline. You can play, pause, restart, pick up where you left off. Then that's why I like podcasts so much more than watching YouTube, because YouTube, it's a hassle. You stop playing and then you don't know where. It's hard to find it back again, and then you don't have offline playing unless you pay YouTube money. So if that's your problem, I suggest you find this on podcasts, because I don't think I'm going to break this down in timestamps anytime soon, because that would be work, not play anymore. I'm sorry. Okay, that's all for today. I will talk to you later.